Thank you so much, ladies and gentlemen. This is the big panel where you have India's largest banker, India's largest NBFC, and India's largest FMCG company all together in one screen to find an economic vaccine to beat the COVID blues. In fact, our theme is beating the COVID blues, renewing the economy. So Sanjiv Mehta, let me come to you first and let's set the stage. You are sometimes seen, HUL rather, Hindustan Unilever is seen as a proxy for India's FMCG story. You've had a lot to deal with. It's been a busy time, supply shocks, demand shocks. But you've also used this time to have more than 50 product launches, to ramp up your sanitizer capacity by 120 times. You've clearly been very, very proactive. Mr. Mehta, before we go forward, you want to first just address the issue of supply and tell us, is a supply shock behind us? Are you back to pre-COVID levels?
Thank you, Nayantara. Good afternoon, everyone. I'm delighted to be with all of you. So just picking up the cue from Nayantara, yes, to a large extent, the supply problems are behind us, the serious supply problems. But even today, we do have what I would call as the vertical lockdowns, which does hamper both supply chain from a back-end perspective as well as distribution. We have to accept that supply chain works in a very synchronized manner. So even if there is a pocket of disruption, if one supplier or two suppliers, they get disrupted, then the whole chain gets impacted. So while we are no longer, say, in the scenario of April or early May, and we've come a long way from there, and from a gross perspective, gross tonnage perspective, gross volume perspective, I think we are back to normative levels. Okay. Having said that, the demand patterns are different. Demand pattern for what I call as the COVID obsessive categories, like sanitizers and hand wash liquids, they have been very robust. Then on the other extreme, there are categories which are COVID impacted categories like out of home, like ice cream, food solution business, color cosmetic business, so those salon business. So those, of course, still remain impacted because people don't step out. So from a lens, if I were to categorize or generalize, that essential goods are back to where they were before the COVID. But discretionary items, I think we still have a way to go before the demand goes back to the pre-COVID levels.
Mr. Mehta, before I move on, just an important clarification I'd like to have. When you say that demand for at least essential items, COVID obsession-related items are back to pre-COVID levels, are you talking about only supply or are you also talking about demand?
See, supply is, like I said, except when we have the vertical lockdowns, we are back as far as the gross volume is concerned to the pre-COVID levels.
Okay.
But when it comes to the demand perspective, of course, the demand has been moving up. And to an extent, FMCG is what I would call as not recession-proof, but certainly recession-resistant. So to that extent, it does not get impacted as much as some of the other sectors like automobile or tourism or hotel industry. But the key aspect is the discretionary items, not the essential item, not the food and refreshment, not the soaps. Discretionary items like the skin care, the hair care, those are items where the demand has moved up, but it is still not where we would like it to be.
Sanjiv Bajaj, if I can now come to you. We've seen what Sanjiv Mehta has said. You've heard what Mr. Rajnish Kumar had to say. I want to get your perspective, the largest NBFC. What are you seeing as far as demand goes? Your customer is also different from the SBI clientele.
Nayantara, our customers primarily are individual consumers and small and medium businesses, both in urban and in rural India. after the first 6 weeks or so of the lockdown, rural India opened up pretty strongly for multiple reasons. Harvesting was good, rains was good, which gave good confidence. The pandemic effects had not reached rural India, and we saw good growth numbers coming from there. As far as urban India is concerned, the lockdown impact started wearing off, I would say, from the second half of May. And June and July, I would say part of July, we started seeing good growth numbers even in urban India. However, as we know, from July till literally middle of August, or maybe even end of August, we have seen random local lockdowns. And Sanjiv talked about how this disturbs supply chains. So we've seen significant disruption of the supply chains, which means unavailability of goods even when people want to buy them. Plus, jobs get compromised, confidence drops, and as a result of which consumption drops. So that has been unfortunate, and that's why I'm happy to see that the last reopening order that came from MHA, I think 2 weeks ago, had a sentence which told states not to unilaterally lock down parts of the state. And I hope that this is something where the center and the states can work together, because it is impacting the entire economy. Again, the last few weeks, things are looking like they're improving. Unfortunately, the pandemic is spreading, so it's there all around us. And I think it's our duty as citizens to practice all the safe distancing, hygiene, so that we can keep the economy running. We are fortunate that fertility levels are low in India. We don't know why, but that's the benefit to us. I think we should leverage that, keep the safety, and keep the economy humming. That's important. So as long as supply chains stay open, as long as local lockdowns don't happen, and those won't happen if we all individually behave in a responsible manner, we should see this economy coming back.
Mr. Bajaj, has that started to happen? You know, we're also talking at a time when Shraddh has come to a close. During the pandemic, or should I say during the lockdown, your customer acquisition, the quarterly run rate, for example, had dropped to what, about 0.5 million, down from the 2 to 2.5 million customer acquisitions you were undertaking quarterly. Has that started going up?
It has started improving, but the drop was for two reasons. One, there was less customers that were coming to buy things. But the second was also, as we were on one hand staying open for business, but we also had to manage our risk. So we were doing more with existing customers rather than actively pursuing new customers, which we would in better times. So both those reasons why you saw acquisition of new customers coming down. It is gradually improving, but as I said, this is not a instant in time. We still have at least another 2 quarters, if not 3 or 4 quarters ahead before things start normalizing. And hence
2 to 4 quarters more to normalize.
2 quarters at least. 2 quarters at least, and maybe even more, because let's be clear, this is the first time we are seeing a virus having such an impact in 100 years. We can all guess how long it's going to take for this to recover, but we don't know. So we have to be prepared. So being hopeful is one thing. Being prepared for tougher times is something equally important for businesses to do, to make sure that we get out of these times, if not stronger, but at least more resilient. So my hope is that going forwards, we continue to see some restraint on local lockdowns. We continue to see better day-to-day sense prevail amongst citizens, so that we can keep the economy going.
Mr. Rajnish Kumar, right now, are we that $3 trillion economy like an A380 aircraft in a free fall?
So it will be requiring a lot of effort, as Sanjiv has mentioned, and normalization of supply chains. The demand side, one is, again, I'm coming back to the same point, that India has a serious infrastructure deficit. And we can, and there is a national infrastructure pipeline for 5 years. If we get it right and fund that infrastructure pipeline of 110 trillion rupees, which is almost $1.5 trillion over 5-year period, that itself can give the boost to the economy in a big way. Because we have to analyze sector by sector. What are the sectors which create jobs? And when jobs are created, they create demand. Still, there is a lot of dependence and what is called disguised employment in the agriculture sector. So it is very important that the construction sector, which is a large employer of the labor, how do we give a fillip to the construction activities and to build the required infrastructure? And what it does is, apart from creating the jobs, it does improve the overall productivity of the economy. Because infrastructure bottlenecks is one of the major issues when it comes to the export competitiveness of the country, or the high rates of the power, high rates for the land. So when we are having an economy where land, labor, power, so everything is costlier coupled with the infrastructure bottlenecks. So how does the economy become competitive as compared to the other countries? So apart from the fact that there is a disruption on account of the COVID, let us forget that there was no COVID. And then what will we do to improve the growth rate and the competitiveness of the Indian economy? So once we start viewing in that perspective, we will get all the right answers.
No, but Mr. Kumar,
and COVID-19 has to be
but I don't think we can look at it even like that, because the world will never be the same after COVID-19. If I could very humbly interject there, you also have the US Federal Reserve, which is coming out with one bazooka after another bazooka after another bazooka, and you have to be competitive in that environment. We talk, Mr. Mehta rightfully talked about, we still don't know what our fiscal glide path will be. We have no intimation from the government on that front. Should our interest rates be lower? Look what the US Federal Reserve, for example, is doing. We're going into the next Monetary Policy Committee not even knowing who the members are going to be.
No. One is that these comparisons to me, they are not valid comparisons. A $20 trillion economy with a per capita income of 60,000, how do you compare an economy which is less than 3 trillion and per capita income is less than $2,500? So the resources which a US government has, or a European Union member has, or Germany has, they are not the same. So one is, we should know that what we have and how do we make best use of it. US government can probably afford that in every account they will put $3,000. Indian government, they could have only afforded that they will put 500 rupees in Women Jandan account in 3 months. Or they will give a 6,000 rupees credit to farmers over 12 months. And what also we have to realize, that you can put money in the accounts of the people, but can you prompt them to spend? What is happening? That whatever money even it has put in, so it has swelled my deposits. And the spending is yet to resume, because then here is a psychological factor about the COVID. So it is very important that this fear of COVID also, it needs to be removed from the minds of the people before they really start spending. So today, focus for everyone is on essentials. You have to spend, you invest. On the consumer drive, this is what is called the discretionary spending. In my view, it will take time. There would be certain sectors like, say, aviation, tourism, leisure, luxury goods. These are not going to come back or revive very soon. But if you have constructed road, if you have to construct a railway line, if you have to improve your railway stations, if you have to invest in renewable energy, so there is no psychological factor in this. So what you are talking about, that COVID-19, it has a impact on the mindset of the people. And on the consumer side, this is some time away. As I said, certain sectors, it is some time away. But there are certain sectors where you can push investment even if COVID is continuing for some more time. So that is the limited point.
Can I ask you, it can't stay away from banking. Let's take your sector at large, right? It's never going to happen. The government or the Reserve Bank of India, during a crisis, it has to make sure that banks give a lifeline, whether now it is going to be on a moratorium, which I don't know what's going to happen to the interest on the interest, or it is a one-time restructuring, which the government itself was so keen on at a time when some of the largest financial institutions in the world today, the top 20, are not even banks. So I want to also ask you that during this crisis, when everyone's adapting, what is going to be the future of a bank? What is a bank going to look like in the post-COVID era?
So banks, again, I'm saying that it's not about COVID. In any case, a profound shift is happening in the financial system across the world. COVID has just hastened that process, and the pace of digitization has gone up. That is what the COVID impact is. But otherwise also, the future of a bank or how the banking or a financial system would look like, in any case, it would have been very, very different, because there are certain things where its time has arrived and you can't do anything about it. So in a world today, if you are not investing as a bank or a financial service provider heavily in the digitization of your processes, so you will become extinct. There's no future for anyone who is not tech savvy or digital savvy. And digital means what Sanjiv was talking about is your capability to analyze the data for providing, number one, newer products and services, your underwriting, your risk management, everything. And at the same time, the customer convenience. So now we are seeing a trend that people, in any case, were not coming to the branches. For State Bank of India, 7 out of 100 transactions only happen at the branches. And that trend is going to continue. But the capability to deliver digitally, which a bank like a State Bank has created, or Bajaj Finserv has created. So this is the new trend, and ultimately banking, the way we are imagining at SBI is that it will be a big digital platform, and branches will be just the nodes to provide the physical interface, rather than the earlier model where branch was in the forefront of the business and the technology was at the back end. Now there is a complete reversal. The technology and digitization is at the center, and you have to reimagine banking and financial system where branches or physical presence will be just for some sort of a contact point or a sales or a after sales service, and origination of business, handling of business, underwriting of the loans, everything is going to happen in a contactless manner. And that is where the entire ecosystem is moving. And in my view, we are moving in the right direction. And when we talk about the fintechs or the new lenders, there's a huge market which is still relying on the informal borrowings, and which are very costly. Sometimes it is not uncommon that a person with a low income base would go to the money lenders and borrow money at 30% or 36%. It is not calculated annually. It is called return my money after 1 week, and on 100 rupees, you will pay me 110 rupees. So calculate the annualized cost and you will know what is the cost of that borrowing. So that is where the fintechs, or as Sanjiv gave his own example, so they are filling in that gap.
Sanjiv Bajaj, what is the future of NBFCs? You know, you just heard the governor, Shaktikanta Das, say very recently as well that, you know, it's still vulnerable, 100 are being monitored, we can't have another failure. At the same time, you know, there's been this blot on shadow banks, on a couple of shadow banks after INFS, but I'm sure you would argue you are the future. So how will you do that? By embracing technology. And after you've just heard the chairman of India's largest bank talking about the reduction in transactions at the physical branches, that's going to be very crucial to watch out for going forward and as we beat COVID.
So let me start by saying that the chairman of the biggest bank has a board behind him which says SBI and also says YONO by SBI.
YONO, yes, I'm watching that.
What you are going to see of incumbents, of the smarter incumbents, these are going to become the fintech companies of the future, not the new fintech companies. It doesn't mean a few of the new fintech companies will not make it. But please keep in mind, lending is a leverage business. In private equity, you can fund 10 companies, 8 go bust to make 100 times return and you make return on your fund. But if you leverage that 8 or 9 times with debt, on debt, you don't get the 100 times return. You only get your interest back. So a lending business through the new so-called fintech route cannot follow the same dynamics as other typical private equity businesses. Because if you lose your debt on 8 cases, on 2 cases, you can never recover it. So, so it's a fallacy to think that, you know, fintechs are going to take over incumbents. But it does not mean that incumbents should just sit on their backsides and do nothing, just because they have a protective regulatory environment. And if the largest bank, a public sector bank in the country, can become digital in less than a decade, and they don't talk about it as much, so people don't realize it's, you know, it's always more glamorous to talk about the fintechs. We don't know the change that is being driven. The same is true for NBFCs. Why is everybody worried about NBFCs? Because in the last decade and a half, they have now come to a particular size where they matter, where if they fail, it can cause systemic risk to the lending system. And that is why you need greater regulations around them. But you also need to realize that these large NBFCs have, over the last decade and a half, created a position for themselves, help expand credit in this country, done many of the things more innovatively, understand risk in a number of areas, from rural lending to gold lending to lending against for used commercial vehicles, and have built new models which are going to support this country as the country grows. So they need to be supported as well, whether it's with liquidity. Every time we've seen a crisis in the last 4 years, from your DeMon to ILFS to DHFL and COVID, why do NBFC stocks fall by half? Why does credit get squeezed? Because investors believe they will not have access to strong liquidity lines from RBI the way banks have. Why shouldn't large NBFCs have that? And if it comes with a certain security, so you have to be willing to provide that security. So I think the time is gone really to think about NBFC and bank. The time is to say that there are a set of lenders. How can we use this to leverage ourselves to the 8 to 10% growth for the next 30 years that Sanjiv was talking about, that we need to take our country onto a completely different platform? How do we leverage Atmanirbhar India without having a number of strong lenders? I would say let a million flowers bloom. I would like to see 2 to 3 new banks a year for the next 5 years, for the next 10 years.
And I'm sure we're not having to reduce your equity or to create the ring fencing for licenses, but that's a totally different debate. But Mr. Bajaj, you know, when you're talking about all of this, I'm going to ask a question which I'm playing devil's advocate here. I hope you'll allow me to ask it. It'll make me unpopular with you maybe for asking it. Why is it that when we talk about becoming Atmanirbhar, pump priming, growing the economy, we always look to the government for funding, for liquidity, for policy intervention? Isn't it also time that corporate India also rises to the occasion You can't have a situation where the losses are to be funded by the government and by the taxpayers, but the profits and the bottom line is to only be enjoyed by the company and its shareholders. Don't we need, would you admit that we need a change in mindset on that front as well? Because you didn't see the kind of capex increase after, for example, the corporate tax rate cut.
So for example, let's not talk about a few crony capitalists with a few crony bankers and a few crony politicians. Let's talk about the fact that 95% of all of them are good and wanting to build a good economy. As Sanjiv Mehta already said earlier, any benefit, any support given today cannot be for the sins of the past. It has to be for businesses that were genuinely doing well, but that have been caught in this COVID trap. And when you're in that hole, there is only one person that can print money, and that is the government. And that's the expectation from the government. But that expectation is not to create a protectionist regime. Atmanirbhar India should not be about protection. Atmanirbhar India is about India becoming the second factory to the world. And that's an opportunity which we all know because of a number of global issues, political issues connected to China that has come to us. But let's be clear, the Vietnams and the Philippines of the world have already started acting on this. If we only keep talking and not acting, we will lose. We will miss that opportunity. And in the next 10 years, we have to ask ourselves, where will 500 million Indians who will be young in their 20s and 30s looking for jobs, get their jobs from? So it's not only the opportunity and the luxury of growth, it is a responsibility and a huge need that comes upon us.
Okay, with that note of optimism ahead of the festive season, I'd like to thank all three of you, the giants of India Inc.